Federal Reserve Chairman Jerome Powell today emphasized the need to continue raising interest rates until the Fed is confident that inflation is under control and closer to its 2% goal. Listen.
Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
Well, Powell's highly anticipated speech came just moments after the Commerce Department reported consumer spending rose 0.1% in July, slightly slower from June's 1% increase. So what does today's numbers actually mean for you? Here to discuss is Senior Fellow at the Heritage Foundation and the former Senior Economic Advisor to President Trump, Steve Moore, and Business and Market Analyst Seth DENSON. Gentlemen, welcome back to the show. All right, economy sometimes it gets a little bit heady. Steve, help us break down what today's message meant from Jerome Powell and what do these numbers actually mean for the economy?
Well, the stock market sure had a hissy fit today, losing 1,000 points on the Dow. I actually think that Jerome Powell has been a pretty poor Fed chairman, but I liked what he said today. He did sound hawkish. He's right that if we're going to get this economy moving again and out of this recession, this Biden recession, we've got to get inflation under control. And we got some slightly better numbers on inflation this morning. But when you still have 6, 7, 8% inflation, that's way too high. We've got to take some aggressive action to bring that inflation down. And that's exactly what Jerome Powell said today. Now, whether he sticks to that message, who knows? He's been behind the curve now for 9 months. Remember, it was Jerome Powell who, 9 or 10 months ago, said that inflation was transitory, temporary, it was going to go away. We need to get that inflation down to 2%, and it's going to take some tough medicine.
Yeah, it was him at this conference last year that said it was transitory. So this was his time to prove that he has some credibility still here, Seth. But at the end of the day, it can take a little bit of time for the Fed, once they change rates, to actually come into play. Some people have been concerned that the Fed is overplaying their hand. How will we know if they've taken things too far?
About 6 months after they do it. This is not something that happens immediately. Certainly, as Stephen alluded to, the markets throw themselves into a tizzy. I was actually appreciative of what Fed Chair Powell said today. We've needed responsibility for a while, and he said he's going to remain strong. He did say something today that I didn't agree with, was the underlying positive current in the economy. I don't sense that. This economy's been fueled completely by debt. And the decisions out of the White House over the last week and a half, effectively throwing another $1 trillion of debt between the Inflation Reduction Act and this insane student bill, are only going to exacerbate problems. So the Fed's got his work cut out for him. He's fighting two fronts. He's fighting inflation. He's fighting an administration.
Okay, so some people have said, whatever the market does, whatever the Fed does, ultimately forecasts what other people are doing. So they shouldn't show too many of their cards. They should hold their cards close to their chest. Do you agree, Steve? Should they be more or less transparent, rather, because it could jeopardize the market?
No, in fact, I'm very much in favor of a rules-based monetary policy. So I think it should be basically you just declare, for example, that we're going to allow commodities. There's a commodity index. You should just keep it the commodity index level, and it's almost like an automatic thing. Look, more transparency is always better than less, and we made a big mistake with all this. Seth is right. The massive trillions of dollars of spending, it's $4 trillion now. If you add up the spending from last year and the spending that they've done just in the last 4 months, and that you're just deluging the economy with cheap money and debt and government spending. And obviously that's going to have a very negative effect on the economy. And obviously it's going to cause inflation. I'm surprised that people in the Biden administration can't connect those dots.
Yeah, I think a lot of people are surprised. Seth, I have 30 seconds left. How long is it going to take us to get to 2%?
With the spending still in Washington, I'd rather pick red or black at roulette. But nonetheless, minimum 24 months if we stop now.
Right, 24 months?
Yes.
Oh, that is not good news. That is not good news on a Friday, but appreciate the transparency, Seth. Steve, Seth, it's always good to see you. Thanks for helping us break down these numbers today.
Thank you.
Lindsay. Good to see you, Steve.
All right. Well, coming up, the pro-life battle is on the ballot in November, but are Republicans doing enough to capture the momentum? We're going to discuss after the break. Don't go away.